Hello and welcome to another episode of What to Know. My name is Marvi Gamon, and guess what? Today's video is sponsored by Acentra Credit Union. Thank you very much, Acentra. Today we are talking about buying a vehicle. We will cover your borrowing options, what to budget for, and how to pick the right car for your needs. I'm joined by Alvaro Macias, the Vice President of Community Development at Acentra Credit Union. Alvaro, why don't you tell us a little about what you do?
Thank you, Amabi. I'm in charge of outreach at the credit union. I teach financial education and give people the knowledge they need to be smart consumers.
That's wonderful. I'm sure you see many people looking to get a car on their own. Where should they start?
Well, first, you need to know what you can afford and how long you plan to pay. If you cannot afford to buy a car outright, you can apply for a vehicle loan at your financial institution to see what you may be approved to borrow.
If someone needs a loan, do they have to have a down payment? And if so, how much they should have?
Not all lenders ask for a down payment, but some might due to a company's guidelines, the vehicle type, or your credit score. The loan to value, or LTV, measures the amount you need to borrow against the market value of the vehicle, which can also require a down payment if a vehicle is being bought for more than what it's worth. Down payments are typically 10 to 20% of the purchase price, but can be up to 50% in some cases. Down payment can also help reduce your monthly payment and interest costs as well.
I'm glad you mentioned that. What should borrowers expect to pay in interest?
Well, each financial institution offers different interest rates, and rates also change. Anyone looking to get a loan should shop around for a good APR, or annual percentage rate. That decides how much interest the borrower will pay for the vehicle over the length of the loan.
So how long will they be paying on the loan?
Most auto loans last 60 to 72 months, which comes out to be 5 to 6 years. But they can range between 2 to 8 years. Longer loans tend to have lower monthly payments, but you pay more interest overall. For anyone shopping for a car right now, Acentra has a special holiday deal on auto loans. Through our annual Ride 50 promotion, anyone who gets an auto loan or refinances their current vehicle can get $50 themselves, and $50 will be donated to the Salvation Army. They must use the code RIDE50 when they apply, and the promotion runs through December 31st.
That's beautiful. I've heard about leasing a car. Can you please tell us a little about it?
Yes, leasing is an option that lets you borrow a vehicle without actually owning it. Contracts tend to last between 2 to 5 years, and the payments are typically lower, but there are some downsides. There is usually a down payment or security deposit required, which can range from hundreds to thousands of dollars, and it's not always refundable. Leases also restrict your mileage, and typically it's about 10 to 15,000 miles per year that you get. And many charge penalties going over that, and it could be 25 cents per mile, which can really add up. So that makes a difference if you often drive long distances or plan to take your vehicle on vacation. You also have no customizations, so you can't put tinted windows or add some rims or change something drastic in the interior, or any other features that you really just can't do. The biggest drawback of leasing is that you have no ownership of the vehicle. So, for instance, if you buy a car on loan, at the end of the loan, you own it and you no longer have to make payments. Then, if you want to sell it, you can make money out of it. With a lease, payments go to pay the contract. You don't earn equity, so you get no money back at the end as long as you lease. You keep making payments. There may also be fees if you end your contract early.
Now, at the end of the contract, what happens with the car?
It goes back to the dealer for someone else to rent and to lease. At that time, you can either sign a new contract, purchase a vehicle, or go without one.
So for someone looking to buy, you covered monthly payments, down payments, and interest. What other costs should they prepare for?
There are several financial factors that you want to keep in mind, from initial cost and ongoing expenses to planning for the future. Some upfront costs include the title and registration of the vehicle, showing that you are the legal owner and putting it on record with the county. Then there's taxes for the purchase or use of the car. Upgraded features also increase the price. You have basic functions like heat, air conditioning, power windows, they're all considered standard. But say heated seats, a navigation system, remote start, a towing hitch, and other items like this are all considered additional upgrades and can cost you more. Then you have ongoing expenses like fuel cost, which can change. So it's best to leave a little extra room in your budget for when prices go up. Also, insurance protects you in the event of an accident or theft. Premiums have to be paid monthly, every 6 months, or annually. And if you file a claim, you also need to pay a deductible at that time, which is a dollar amount decided by your insurer before they will pay anything out. Some lenders will have a maximum they will allow for a deductible when they're providing a loan.
How do drivers know which insurance they should go with?
There are different types of insurance available, but if you get a loan or a lease, full coverage will be required. That includes collision, comprehensive, and bodily injury coverages. Now, collision coverage repairs or replaces your vehicle if it's damaged in an accident, regardless of whose fault it is. Comprehensive protects you from incidents of theft, vandalism, or natural disasters, and bodily injury pays for the treatment of injuries to the drivers and passengers.
What about for someone who buys a car outright? Do they still have to get full coverage?
They don't have to, but it is still recommended. There's something called liability coverage, which is cheaper, but it only covers damage to others if you're at fault. That means the owner would be responsible for paying for all the repairs of their own vehicle. And speaking of, maintenance and repairs are also important when deciding on a car. You're expected to do routine maintenance to keep your car running well. Things like oil changes, tire rotation, new tires, replacing your air filter or coolant, and there's many more.
How much does all of that cost?
Service costs and parts vary a lot based on the vehicle type. If you're able to do some of the work yourself, you can actually save some money. But according to the AAA, the American Automobile Association, they say the average yearly cost of routine maintenance is $792 a year. Most mechanics charge between $75 to $125 per hour for labor plus the cost of parts.
That seems like it could get pretty costly. Is there any other way to help buyers avoid major repair expenses?
I would suggest to look into warranties or waivers. At Essentra, they can be purchased outright or added to a car loan, and the prices are significantly lower than what you would pay at a dealership. I'll go over the four most common. Mechanical breakdown protection is also known as an extended warranty. It offers coverage in the event of a breakdown of major components like the engine or transmission. Guaranteed asset protection is also called GAP waiver and helps when a vehicle is totaled or stolen and not recovered when you still have a loan on it. If a borrower's insurance doesn't pay out enough to pay the loan, GAP will pay the difference so they aren't still responsible to pay on a vehicle that they no longer have. Now, depreciation protection or down payment protection is similar to GAP, but the benefit is based on the purchase price, not the borrowed amount. It's mostly used when a large down payment is made, so if the waiver pays off the loan balance, the borrower can keep the insurance payout to use for a new down payment. Lastly, debt protection is credit, life, and disability. It protects borrowers and their families from financial hardships in the event of illness, injury, or death. It works by postponing payments for a period of time or eliminating the debt altogether depending on the plan and situation. Now, warranties do cost extra, but it's impossible to know what will happen. So having coverage can make a big difference in your financial life later, and especially when you're buying a used car.
That's great advice. There are some things you can plan ahead for, right? Can you tell us some of the things buyers should be looking for to make sure they pick the right car?
Absolutely. Some questions they should be asking themselves are, do I plan on growing my family? Do I need extra space for gear or sports equipment? Do I have any aging family members that may soon need travel assistance? If so, it's probably best to look for a larger car, four-door vehicle. Will you be driving long distances very often? Will you pass a vehicle to a child later on or another family member? Then it may be best to look for a car that you know it's more reliable and has extra safety features. Will you be taking this out in the country roads or driving on gravel? Will you be driving on ice or other dangerous weather conditions? Then a vehicle with four-wheel traction, four-wheel drive would be something good to look at, or something that you don't mind getting very dirty. That would be a good choice. So don't just think about how you're going to use the car right now, but think about in 5 years before you settle on that decision.
Doesn't a car lose value over time too? How does someone know they are getting a vehicle that isn't going to lose too much value?
Yes, that's called depreciation, which measures the value that drops due to the vehicle's age, wear and tear, and other factors. J.D. Power and Kelley Blue Book are trusted websites that tell you what a vehicle is worth based on the vehicle identification number, or VIN, or some other car details that you put in there. Now, Kelley Blue Book says that new vehicles lose about 20% of their value in the first year and 60% in the first 5 years. That means that newer cars lose their value a lot faster than older cars because the older cars have already depreciated. So if you're looking for a vehicle that is going to be the most affordable and hold its value longer, you might be better off buying a used vehicle.
Thank you for sharing that. Do you have any other advice for someone looking to buy or lease a car?
Yes, whatever you decide, make sure that you do your research. Test drive the vehicle. Check if the make and model has any known recalls. And use the VIN number to look up the vehicle's history. Ask the dealership or your lender to provide you with a Carfax report. Now, a Carfax report will tell you if it's been in any accidents, floods, or something else that may lead to some issues that you can't see. Also, be aware of rebuilt or salvaged titles, as that means the vehicle may have been totaled in a flood or suffered severe damage.
Thank you, Alvaro. I appreciate you sharing your knowledge here with us. Thank you again to our Central Credit Union for sponsoring this video. To learn more about making smart money decisions in America, make sure to like, share, and subscribe to our channel, because knowledge is power. I am Mavi Gamon. Thank you for watching.